Hello and a warm welcome to Econoday Unplugged on Tuesday, the 12th of October 2021. Mark Penders on the US East Coast and I'm Jeremy Hawkins in London. Well, despite the rather lukewarm US employment report last week, the Fed still looks poised to begin tapering next month. However, in recent days, speculation has increased sharply that amongst the G7 countries, it'll be the Bank of England that's first to pull the trigger on interest rates, as doubts build about the supposed transient nature of UK's above target inflation. More generally, supply chain disruptions, which look unlikely to end anytime soon, are having an increasingly negative impact on some parts of the global economy, particularly in the likes of Germany, where goods production is tumbling due to shortages of key inputs in the auto and construction sectors. And the cutback in output in one industry will inevitably lead to reduced demand for products in others that supply it. In fact, it's important to note that in this environment, apparent weakness in, say, retail sales might be just as attributable to a lack of buying opportunities due to inadequate supply as it is to any form of consumer retrenchment. Investors and central banks alike will need to interpret the data carefully. And talking of careful interpretation, Mark, was there anything in September's employment report to give the market pause for thought about Fed tapering in November?
Yes. That the Fed may step back from tapering.
Yeah, I mean,
Well,
market generally seems
yeah,
to be written in there, but I mean, is it a done deal, or are there some funny
no.
bits and pieces there that people have missed?
There's definitely funny bits and pieces. The headline itself was 194,000, which was for the second month in a row below Econoday's low estimate, and it was less than half of the 475,000 that was expected. Importantly, it's the participation rate has not recovered at all. It fell back a tenth to 61.6%, and this is a point and a half below where it was. It was already subdued going into the pandemic, just over 63%. And now it has just been laying flat. And if you look at the total employment, civilian employment levels in the U.S. In September, it came out to 161.4 million. That this includes the self-employed, 161.4 million. In February going in, it was 164.5 million. So there's 3 million, and these are people who are looking for work. A small percentage of those they're considered to be in the labor force if they're actively looking for work. So this group is down 3 million workers, and this is at a time when demand is up and hiring and available labor is scarce. And where did these people go? There a mortality question? I mean, I hate to ask that with COVID, but there must be, to a limited degree, that has to be related to that. But there's something else going on. Maybe it's the emergency benefits that are keeping people at home. Those have been winding down. That's another factor with September. It didn't show millions of people went off the doles in September, but it didn't show up yet in the statistics. It may begin to, people may begin to be forced back into the labor force. But that's the critical question, I think. And Powell, who has consistently, like Yellen, his predecessor, pointed to the need for a balanced employment recovery, and this references to minorities, this references to the low wage group, and to get their participation up. And he's repeatedly said that they're not going to be withdrawing stimulus until, or that their assessment of the labor force will include, very importantly, those disadvantaged groups and how they evaluate the success of the recovery. And judging on that, and like I say, the general headline, I mean, you can find things in this report that are very strong, as the markets have. If you exclude the government workers, the numbers go up. If you average it out with the prior months, the numbers go up. And wages look good, and the work week, of course, is going up because everyone has to work. That do have a job have to work a little bit longer. and there's recovery in key sectors, whether manufacturing or construction or leisure and hospitality, which has really been hit. Those are all favorable things, but what the markets are going to need, and if you're an investor, you beware, is guidance from the Fed speakers themselves. Now, today, there's several on the docket. We have Clarita, he's the Fed's vice chair. We have the president, Bostic of Atlanta, who speaks often. We have Barkin out of Richmond. They're going to be on the Huskings today, and they're certain to have to put their 2 cents in on how to interpret these numbers. So, and the assumption was that because the Fed had said, one single indicator, it has to be decent. And that was Powell at his press conference. And so one single indicator was decent. I mean, it wasn't great, but it was decent. But it's, as you say, there's two sides to the coin here. And it's interesting that have you seen anything over the weekend? Did you see any interviews from Fed people? I haven't seen anything.
No, I can't say I have, no.
So maybe they're getting together. I don't know. They're on the phone with each other trying to sort out how they're going to approach
what are we going
this.
To say?
What are we going to say? And, because the first one who starts coming out, it could be, some of the usual suspects who voice their opinions, often hawkish opinions, and they could get out first. They haven't yet. So we'll see. We'll see how this unfolds. If the Fed does somehow start beginning to step back on tapering next month at their meeting at the beginning of next month, I think that I don't know what that would do. You would think it would be good for the stock markets, and you'd think it would bring interest rates down. But maybe there would also be the thing that the element that the confidence in the decision making at the Fed, and so that's another issue too. So.
Okay, well, I guess part of that comes down to, at least, well, some of the numbers we'll get between now and then, and you've got a couple of important ones this week in the shape of the CPI and retail sales. I want to ask you particularly about retail sales. In the intro, I mentioned, or at least alluded to, the fact that certainly in Europe anyway, we're seeing some of the weakness in retail sales being attributable to the fact that would-be buyers simply can't get hold of the goods or services to buy in the first place. Hence, it doesn't come to in retail sales. So are you looking for anything like that to occur in your retail sales report, which today it's Friday, isn't it?
Well, it's interesting because that's, an assessment that's impossible to discern from the numbers themselves, the mix between supply constraints and has demand already been filled. And another issue, when you were in the introduction, you had mentioned that lack of supply will help. Presumably may help prices anyway. I mean, it had in the past been making prices go higher, but if demand is coming down because supply is coming down, maybe that will help ease prices. So it's it's an unknown combination of the two. I mean,
well, I guess what I'm particularly looking at, says the auto sector, because over here, the auto sector has been, I say Germany is the classic example where it's been completely clobbered by the fact they can't produce the items in the first place due to the fact they're not getting the raw materials. So auto sales, I should say, perhaps rather than demand is a better word for it, auto sales across Europe have been falling through the floor over the course of the last couple of months. And that isn't to do with output so much. It's to do with demand, I should say. It's simply to do with the fact that the vehicles aren't there to purchase in the first place. I wonder if that's true.
Yes, well, that's definitely true. Auto sales have been coming down dramatically and much more than forecasters have been expecting. But they had been at the reopening pretty strong. So maybe the question of availability, maybe the people who did want a car and could afford a car have got their car. And I guess this will go back to prices as well. Auto prices have been, autos have been distorting all the economic data over here. Just looking at the annual rate of vehicle sales came out in September at 12.2 million. That is amazingly low. That's almost 5 million annual rate lower than it was at the beginning of the year. And that's the lowest rate since the lockdown in May last year. And so the economy consensus for headline retail sales is a 1/10 decline. Yet when excluding autos, that goes up to a 0.4% rise, which is which would be a respectable gain. And we saw it in the trade data for the U.S. Last week, with both imports and exports of vehicles way down. So there is this, bottleneck happening in this very, critical position, or this element in the economy. It didn't seem, I don't think, let me just go back and look at the numbers, to have grossly distorted the employment report. That was a risk with the employment report, that the goods producing sector would have been held down by autos. But there again, then there's the seasonal issues, because over here, the automakers shut down routinely during the summer. And they didn't do that this year because of the scarcity of production. They kept their factories open, which have completely, when you apply these seasonals that have been based on these cutbacks, then you get these distorted numbers, which are very difficult to read. I guess the answer is yes, and I just wanted to throw in whether or not, I guess ultimately we would likely see it in the CPI, is how are auto sales, or how are auto prices being affected? If they start coming down, or they start to moderate from these high levels, then that, I think, could be an indication that demand isn't increasing, accelerating as it had in the past.
And what are we looking for? Lisa, what's the market looking for with regards to the CPI?
Okay, the CPI here, it's on Wednesday, and I'll call it up here on the Econoday calendar. We're looking for a 0. The Econoday consensus is a 0.3% rise overall, which is a pretty moderate rise given all the distortions, and that would match the monthly rise in August. This is data. This will be data for September, and so that would show a non-accelerating rate on a monthly basis. Actually, the annual super elevated at 5.3%, but that is also expected to be unchanged. The core, which was unusually low following huge gains in prior months, in August it only was up 0.1. We're only expecting a 0.2% rise, and a 4% core rate annual. If we get these numbers, these are pretty tame, and these are also, it's not as important as employment to whether the Fed begins to taper or not. But if these numbers, I don't think that these numbers will push or will make the hawks, unusually alarmed. But if these numbers come in above expectations, and if they do include accelerating prices for cars, I mean, that could be you could expect that too. I mean, if there's a lack of availability, you're only selling 12.2, and demand is actually extremely high, then we're going to see higher prices, and then that could feed into these numbers, and then the Fed would have to come in and explain to everybody that these are still transitory issues, and it's going to get a little bit murky and cloudy, and I don't think that the Fed's credibility needs that. So my hunch is that they are going to stick to their guns and begin to taper.
Okay, excellent. Thanks for that little lot. Right, okay, let's move across to Europe then. And so I suppose Mark was talking about retail sales, so just to put things in perspective, Europe is still lagging quite significantly on that front. We had the August numbers, as usual, the European figures lag somewhat behind what get on Mark's side. Only up 0.3% on the month for August, which means that we take the first couple of months of the third quarter together, and these are volume numbers, of course, it's measured in real terms in Europe. They're up just 0.1% versus their second quarter average. And the second quarter, they actually were up 4.0% on a quarterly basis. So in other words, it looks as if the retail sector is going to make a much smaller contribution to third quarter Eurozone GDP in the third quarter than it did in the second quarter. And that's clearly one reason why the ECB is still very cautious about what to do with policy, and it'll almost certainly still be one of the last of the major central banks to come out and do any kind of tapering. And that was really enforced by some of the goods production numbers, which, as we've been talking about, have been hit badly, particularly in Europe, from the lack of raw materials and indeed intermediate inputs as well. In Germany, last week we had news of a 4% monthly fall in overall industrial production on a month-on-month basis for August. And that was well below what markets were anticipating. And in fact, it now means that German industrial production is 9% below its pre-crisis level back in February 2020. And indeed, it's actually at its weakest level now since August of last year. So in terms of a contribution to the German economy coming out of what is one of its key, very much its key areas, manufacturing, well, it's not really happening at the moment. And as we going back to the intro, and that's starting to be reflected now in some other parts of the economy as well, where the simple fact that they're not building these auto cars anymore means that demand for the likes of windscreens and everything else from tires simply isn't there anymore. That should be said, some of the other countries performed a bit better. We saw a positive growth coming out of France, but Italy was down a little bit. We'll get the full Eurozone industrial production numbers tomorrow on Wednesday. Probably going to be a little bit disappointing again. And I think all of this is being reflected in a way, sort of, not just market expectations, but analysts are looking at the economy as well. We had the ZEW survey out for October this morning from Germany. That's, if you like, is the first of the major surveys we have of what's going on. Although it's only really referring to analysts as opposed to the actual industrial manufacturers and service providers themselves, it was markedly less optimistic about both the current situation of the German economy and the outlook as well. In fact, the expectations component is what the markets get most agitated about. That's its lowest since March of last year, and that was obviously just when COVID hit. So there has been a fairly marked downscaling now of economic expectations, not just for Germany, but it's pretty fair to say I think that's right across the Eurozone as well. However, compare and contrast in some ways with what's going on in the UK. I've got to be said that most of the indicators for the UK third quarter GDP really aren't looking that great at the moment. But nonetheless, from some of the comments we've had coming out from MPC members over the last week or so, they've been hawkish enough to really generate a good deal of speculation that bank rate, which currently stands at the record largest 0.1% in the UK, could be hiked before the end of this year.
But don't they have to taper before they raise rates?
No, they don't. The UK, very kindly, the Bank of England came out with its exit strategy, a couple of meetings or so ago now. And essentially what they said at that time, and presumably this is what they're working with at the moment, is that bank rate will be hiked in one stage, two stages, whatever it may be, to 0.5%. Once it gets there, at that stage, they'll effectively hold the balance sheet flat. So they'll just allow it to just to stay where it is.
So they're going to move their policy rate and keep QE steady.
Yeah, exactly that. And then they won't actually start to reduce the balance sheet. So actually allow assets to start run off, or indeed actually go out and sell the assets until we have bank rate at 1%. So it's slightly different. Obviously, it's different from what's happening on your side.
So did they address why they're doing it differently, or do they care? I mean, or explain it to me.
Well, it's a shift actually for people who remember when we used to have Mark Carney as the head of the central bank. His attitude was that we'd see quantitative easing coming in before we saw interest rates going up. What seems to be happening under Mr. Bailey, Andrew Bailey, the current governor, is that he effectively looking, I think, to try and use both interest rates and quantitative easing, to push them in the same direction at kind of the same time. And it looks like he thinks that, you need to get interest rates up to a sort of semi-neutral level before they start doing anything on the quantitative easing side. But it does mean that, as we start going into next year, potentially, it remains to be seen when rates actually do go up, but we'll have a combination of higher interest rates and quantitative easing. And it may be, rates will go up and peak and the quantitative easings will continue for some while. I think one of the issues at the moment is still not just for the Bank of England, but for most central banks is, what is now for want of a better word, the equilibrium level or size for the central bank's balance sheet. And I don't think they really know that themselves yet. So, but at least they can start running down assets, and by raising interest rates at the same time, perhaps it means they can run down assets a little bit less slower than they might have done otherwise, which gives them more time to work out where it should be. But just going back to this, all this speculation about a hike in interest rates, personally, I'm not totally convinced at this stage. Yes, the noises they're making, it does seem now that I think it's to do with what's really going on in the energy market, and looking at the forward curve, the likes of gas prices and oil prices. They're now working on the assumption that inflation will be higher for longer than they originally anticipated. But we did have unanimous 9-0 vote to keep bank rate at 0.1% at the last meeting. And the only dissenters were Michael Saunders, who's perhaps the most hawkish member on the MPC, and the Deputy Governor David Ramsden, who wanted to halt quantitative easing at that time. So I'm not convinced at this stage they're going to get a majority actually in favour of raising interest rates. If we see really high numbers on wages and inflation, there may be no choice. But because the economy appears to be slowing down now, and perhaps slowing quite sharply, don't spend all time talking about numbers, but just going back to retail sales. I mean, UK retail sales have fallen so far every month in the last four months. The September data will need to show an increase on the months of over 12% just to keep third quarter retail sales flat. Now, earlier on today, we had one of these surveys from the private sector, the British Retail Consortium, and they basically came out and said that sales in September were really weak. Potentially, they're talking about a decrease. Now, if we get that, I mean, third quarter UK GDP could really struggle to show any growth whatsoever. And will the bank really want then to be hiking interest rates when they still don't really know what's happened since the end of the furlough scheme supporting employment in September? I've got to say, I'm not totally convinced.
So you're referring to the distributive trades report?
No, this is a completely separate report. This is a British Retailers Consortium survey, which is, as it says, it's a survey of members of the retail sector who are part of this consortium. They simply ask him, how do your sales compare this year with last year? So it's, as you say, it's kind of akin to the CBI distributive trade survey. But it comes out quite early on, and it's not that well correlated. It's got to be said with actual sales. But it's a big switch. They're talking about what they call same sales year on year for September at minus 0.6 compared with an August reading of plus 5.8%. So unless it's badly off the mark, it does suggest that the UK retail sector is going to subtract from third quarter GDP.
Let's switch back to the Bank of England real quick. Now, I remember there was a dissent, if I remember correctly, there was a dissent. And if it wasn't the last meeting, it might have been the meeting before, that one of the members voting members wanted to end QE right away. So have they all agreed on Bailey's point of beginning of tying the policy rate with QE together at the same time, or is there a dissension even in that strategy?
I think on the whole, it sounds as if they're all pretty well agreed. I mean, quantitative easing under the bank's existing program or schedule is due to be concluded in middle of December time. What we saw with regards to Michael Saunders, as the person the MPC member you're talking about, he's now voted twice to end quantitative easing immediately. He did it in September and the previous meeting.
At the same time to raise rates, is he voting for that too?
No, he's not voting to raise rates.
So he's not in line then with the new strategy.
Well, effectively, he's just looking to hold the balance sheet flat now. He's basically saying quantitative easing has done its job, and that's not outside of the strategy. Always saying that. Always saying is, they're not going to start shrinking the balance sheets until rates have gone up. So he's just saying, look, we've done enough with quantitative easing already. We might as well finish it now. And he wanted that in September and the previous meeting. And in the September meeting, he was also joined by one of the other MPC members who also thought it was a good idea to hold quantitative easing now. Yeah. Now, in that said, the quantitative easing is due to end in a couple of months' time anyway. So it doesn't actually mean that much.
Let's move to Brexit. I have a question about Brexit. Is it affecting policy, economic policy? Yeah, in the UK, how are exports and imports doing? Is there pressure, some kind of a trend that has appeared? And what about the backstop with Northern Ireland? Is that just a purely political negotiating thing, or is that actually have any policy risk?
Right. Well, the fallout from Brexit continues, and from a political angle, it's getting quite nasty at the moment. Just in terms of the numbers, I mean, it's as we talked before about on the podcast, it's always difficult comparing current trade figures with what's gone before because differences need not to be about Brexit. You got all the COVID distortions and everything else going on. However, if you put, let's say, some straight lines through recent months of looking at UK trade with the European Union, both exports to and imports coming from, it looks fairly safe to say that Brexit is still dampening down overall trade flows between the two countries. The government's attitude is still, well, there's still a period of adjustment going through, therefore you can't expect it to return to normal. And of course, well, who knows, because COVID effects might be distorting the numbers anyway, which they probably are. But I think the underlying trend, if anything, suggests that Brexit has definitely dampened trade between the two regions. Now, on terms of the Northern Ireland Protocol, that is a seriously hot potato, even as we speak. The UK line over the last few days has been tightened to the extent they're effectively saying they want to rewrite the Northern Ireland Protocol to make it much easier for exports and imports going into and out of Northern Ireland, etc., etc. The EU are making out that, well, there's no way you can do this. You agree to it in the withdrawal treaty, and therefore we're not going to do it. And at the moment, there's a real battle of wills starting to form now between the UK and the European Union about what might or might not be done in terms of the overall treaty. So it's safe to say that the political relationship between the UK and the EU is probably at its lowest level since some negotiations over the Brexit withdrawal treaty in itself.
For
So
economic policy, is there any pressures?
well, I suppose to the extent that you can say that overseas trade is being dampened by Brexit, it ought to mean that growth is that much slower than it would be otherwise. I think
So
that's
they're not making it with the two. Okay, so it was a two-part question, I guess. Is there a economic policy component to Northern Ireland, and the second, are non-European regions compensating for the eurozone
Well,
slowing?
the second question's easy is no, because the eurozone is such a huge trade partner, around about 50% plus of total trade for the UK. You're not going to lose that. We're not losing it obviously, but you lose a chunk of trade there. It's very hard to make it up elsewhere, particularly in the near term. We haven't been able to agree a trade agreement with the US, which Boris Johnson and co. were saying, well, this is one of the reasons for getting out of Europe trade. We can go ahead and form our own agreements elsewhere. They've managed one with Australia, but that's some tin pot really. You're talking about that 1% of exports, something like that, and a small one with Japan. But no, at the moment, there's a hole in terms of overall trade which they've still got to fill. I think in terms of Northern Ireland, it's probably as much the politics as anything else, because remember that Northern Ireland wants effectively to remain part of the UK, but it's struggling to do that because Southern Ireland is part of the European Union and it's not. So I think it's more
Well,
to do
yeah,
with politics there than economics.
it's like if you put borders around New Jersey here or something, right? It's
It is, yeah, it's exactly that. So to be honest, I mean, how you get out of this is it's just almost impossible because you simply can't do it. I mean, you're either part of the European Union or you're not, and trying to be half in and half out, is nigh on impossible. Oh, it really means that both sides have got to trust each other when it comes to border inspections or the lack of border inspections or whatever it may be. And sadly, quite clearly, they don't. Okay, let me quickly round off some other things before, as ever, we talk for too long. Canada, we had their employment report out last Friday as well. Talking of tapering central banks, that was up 57,100 on the month there on the headline payroll data. And that was best part of double or so market expectations, if not more than that. And indeed, it's taken employment back to its pre-pandemic level. Another larger than expected fall in unemployment as well. That's its fourth downturn there. So So bottom line, it looks as if net tapering is very much on for later in the month, or certainly for December anyway. So expect the Bank of Canada to announce that fairly shortly. Elsewhere, I just quickly mentioned China. There's a stack of data coming out on Sunday, including third quarter GDP.
It's Sunday our time. It's
Our
Monday
time, I
their
should say,
time.
yeah. Industrial production, retail sales. Mention that because there's a lot of talk at the moment and concern about, the slowdown taking place.
Slowing.
Yeah. We had car sales earlier on today for September there. They were down 17% on the year. And that says steepest decline in the best part of 12 months or so. So third quarter GDP could come as perhaps as a bit of a surprise on the downside. And that taken together with this ongoing Evergrande problem, they managed to miss another bond payment yesterday, having already missed a couple in late September time. Speculation is beginning to grow about a full blows eased by the People's Bank of China, despite all this talk about possible rate hikes in the UK, tapering talk out of the US, some other rate hikes out of the likes of South Korea earlier on, a couple of months or so ago now, and indeed out of the Reserve Bank of New Zealand. So bottom line is there's still plenty of dislocations in terms of a global central bank policy, which should make for, volatility in the markets and all the more need to keep an eye on what's going on with the economic numbers. Okay, Mr. Pender, anything else to add before we wrap
Well,
this?
the Chinese GDP for the second quarter was 7.9% year on year. I guess that's going to be the number to compare to. We don't have our consensus yet for that. It's been going, it's been slowing and slowing and slowing. So it'll be interesting to see. And it's been missing too. So it'll be interesting to see. That could be the lead off for next week.
Yeah.
That's
going to be important generally. Commodity markets and everything else.
Yeah.
Okay, right. That's it then. Before we do go on too long, let's wrap it up there then. I guess it's worth mentioning that the IMF a short while ago told central banks to be very, very vigilant about inflation risks, and today early policy actions should price pressures prove persistent. However, it also said that expected inflation to subside in 2022. So you pays your money and you takes your choice when it comes to inflation anyway. The jury would still seem to be out. However, what is much more certain is that you can keep up to date with all the major economic data and key events in Econoday's global economic calendar. So do take a look there. On behalf of Mark and myself, thanks as ever for listening. Podcast will be back again next week, and we hope to see you then. Bye for now.